In a previous video, I conducted an intriguing experiment when I asked my viewers to suggest which FTSE 100 company they thought could beat the market over the course of the next 12 months. I then put £5,000 of real money on the line and I bought the 10 most popular choices my viewers came up with. It was an experiment to see if our collective wisdom and insight could beat the market over the course of a year. And here are the 10 most popular companies my viewers chose. Can this Dream Team portfolio defy the odds and beat the market? This is not investment advice and is purely for entertainment purposes. Please do your own research. To set up the new portfolio, I signed up with Freetrade, and on the 15th of June I put £500 into each of the 10 most popular companies suggested. Let's see how we've done over the last 9 months. I'll start with the lowest performer all the way to the highest. In 10th place is Persimmon, and it's had a disastrous time since purchase, down a massive 33%. Rising interest rates and a cost of living crisis has had a negative impact on the housing market. Despite this, we still have a housing shortage, so can Persimmon bounce back? Only time will tell. At number 9 is National Grid. The shares are up just under 1% since purchase. National Grid has consistently raised its dividends for many years. It has a strong economic moat, enjoying monopoly status, but despite this, National Grid still has big challenges ahead. Switching to a low carbon future will be costly and debt remains high. I've held National Grid myself for over a decade, and I believe that over the long term it should do well. At number 8 is Legal & General, up 3.4% since purchase. The company currently pays a big dividend of over 7%. But dividends are not guaranteed, however, and one of its competitors, Direct Line, recently stopped paying dividends completely due to a rise in claims. Legal & General does have substantial commercial advantage and a resilient customer demand, helping it to make over £2 billion in profits after tax last year. And number 7 is Barclays, showing a gain of 5.6% since purchase. The bank's performance remains patchy, however, and its investment arm continues to perform relatively poorly. Yet its core UK domestic business is in good health, boosted by rising interest rate margins. And number 6 is Aviva, showing a gain of 7.5%. It's now a more leaner company after selling off several of its foreign operations and instead concentrating on core geographies and businesses in Canada, the UK and Ireland. And number 5 is SSE, showing a gain of 9%. The company pays a good dividend of around 5%. Utilities are often seen as defensive investments during tricky times. A recent trading statement looked extremely positive, and SSE has ambitious plans ahead in renewable energy. At number 4 is the consumer goods giant Unilever, showing a gain of almost 17% since purchase. Unilever is one of the most resilient brands in the UK, with a strong balance sheet and a reliable dividend. I've been buying plenty of Unilever shares over the last 12 months. At number 3, up over 17%, is Lloyds Banking Group. The share price has had an impressive recent run, and many believe the bank still offers exceptional value. City analysts forecast earnings will rise 6% year on year in 2023. At number 2, with a gain of over 20%, is BAE Systems. The company shares are among the biggest winners over the last 12 months as countries around the world boost their defences. In these difficult and uncertain times, their order book should remain very strong for the foreseeable future. And the company showing the highest gain so far is Rolls-Royce, up an impressive 51.8% since purchase. The company's fortunes is closely linked with the aviation industry, which is now recovering. Despite pressure on spare cash in our wallets, people are flying away on holiday again. Even China is opening up and its citizens are rushing to the airports. In the latest trading statement, large engine flying hours are back to 65% of pre-pandemic levels, and the 2022 results were well above analysts' expectations. Rolls-Royce now has a new CEO who plans to make big changes at the company. There are still some clouds on the horizon, however. Debt is high and Rolls-Royce is on a delicate recovery path, and if there are any new economic shocks, then this company could be vulnerable. Now, before I reveal the overall results, a quick reminder that the platform I'm using for this viewer's portfolio is Freetrade, and if you would also like to use them, then you can sign up using the link in the video description and we could both get a free share worth £10. So how is our portfolio doing after 9 months? The total invested on the 15th of June was £5,031. We are currently up £501, which is a gain of 10%. I also bought a FTSE 100 ETF at exactly the same time to act as a benchmark for our viewers' portfolio, and it's up 10.1%, so we are just below the market by the narrowest of margins. The ETF I chose has the ticker code ISF, and it's up £51 at the time of this video. In my main portfolio, I hold 3 different ETFs, and if you want to know a bit more about them, then I'll leave a link up here. This graph summarises our journey so far, with Persimmon letting the side down here, but all the others are showing gains. Unilever, Lloyds, BAE Systems and Rolls-Royce have all beaten the FTSE 100 ETF since purchase. But as you can see in the last 2 columns, we are down overall compared to the FTSE 100 by just 0.1%, mainly because of what's happened to Persimmon. Perhaps next time we can overtake the index. Now, you may be aware that the FTSE 100 recently beat its all-time record and closed above 8,000. However, big market falls do occasionally happen, and to see how I prepare for them, then click on this video here.